Hello and welcome to today's quick presentation on trade triage, where not all trades are created equal and we need to work out what differentiates a trade and how do we decide which trades we'd prefer to take. Before we move on, I do have to do a quick disclaimer where I'll be outlining that trading Forex on margin carries a high level of risk. It may not be suitable for all investors. The high level of leverage can work against you as well as for you. But before deciding to trade foreign exchange, can you carefully consider your investment objectives, level of experience and risk appetite? It is in your best interest. There is a circumstance where you can sustain losses greater than your initial investment, and therefore you should only invest money that you can afford to lose. Should you not be aware of all the risk associated with foreign exchange, please seek independent advice from an actual financial advisor should you have any doubts. Hit pause and read the rest of that disclaimer. It is in your best interest. All right, let's get into it. So what this presentation is about is working out what trade to take. There is a circumstance in the market where there are many trades that all form together. They all happen at once and you're getting all your signals on multiple different currency pairs all at once. And you don't know whether you should take all the trades, whether you should take one of the trades. And the Murphy's Law is if you take one trade, it's likely to be the currency pair that doesn't move, and then all the others that set up happen to move far more, and you kick yourself and you think, man, why did I pick that one? I should have been on the other one. Well, there is a way to triage your trades, and you need to look at it in a real rational sense and in a way that hopefully at the end of this presentation it all makes clear and can possibly lead to you making greater returns. So trade triage is basically not all trades are created equal. So by this I mean that not all trades setting up are as good as the next, and therefore the success of your trading can be dramatically affected by the selection of the trades you take. So if you were to take and pick the right trade majority of the time, your results will obviously be much greater than jumping on a currency pair that goes nowhere, even though that you got your signals. So the way that I do it, and this is the way I'm going to be teaching you, might be able to come in handy. So understanding the fundamentals of Forex come into play here. And I know many of you throw your hands in the air and say, fundamentals, it's too hard, I'm not an economist. You don't need to be, and it's in your best interest to understand what moves the markets, okay? So if you know that one economy is expanding due to the solid growth and their need to raise interest rates to curb inflation, then you would be right in thinking that that respective currency should increase in value. And likewise, if you think another economy is suffering from an increasing of unemployment, declining wage growth, a slowing overall economy, then you'd be correct in assuming that their currency should be falling over time as the situation is normalized and improving, or is it improving in the eyes of the market? So basically, the economic fundamental data that comes out, all it's doing is painting a picture. It's painting a picture as to the health of the economy. And the markets, the foreign exchange markets, are a forward-looking animal. And if the data now is showing signs of improvement, the currency market is actually pricing it in the right now for expectations of the future. And if the future expectations aren't met, well then the price will correct itself. So you just need to keep that in mind. It's just a very simple philosophy of how the markets work, and when you understand that, you can appreciate what currencies are moving and why. Okay, so with the fundamental skills that I'm basically mentioned above, the best trades which currency pairs you can trade will actually contain a weak currency versus strong currency, or vice versa, a strong versus a weak. And that way, like, these economies are actually polar opposites. And with a polar opposite economy, you're going to get greater price action movements. The movements of the price action is going to be with much more conviction and much more reliable. Okay, so this leads to a more reliable price action and greater success of your trades. It doesn't mull around. The price doesn't just float in a direction and accidentally take out your stop loss because you had it, pretty tight. Where in a real trending market, you'll find that you can put your stop losses tight and the market isn't going to come back and test those too often. So you do want to look for just the basics on a strong economy versus a weak economy, or a weak economy versus a strong economy. As they do, we all know that currencies trade in pairs, and when you're comparing these two, that's where you're going to get the greatest moves. So a currency that has a stable economy, and therefore the government isn't looking to alter anything, their economic policy, or make any physical changes to the way that the governments run or the countries run. So they're basically sitting in the sweet spot. And when this happens, the currency will ultimately idle, it will consolidate. There's no reason for it to increase in value or decrease in value when you are looking at it on its own. So we're not comparing against anything. But when you compare a weak or a strong currency or economy against one of these stable more currencies or economy, then we still should see the price action move in favor of our analysis. So if we have a strong economy versus a stable economy, that strong economy's currency should go up in value versus the stable economies. It's just not quite as convincing and not as large a moves as the polar opposites. But it's still a situation where you're still going to get a high probability of price action and moves. So if you had a choice of the two, you would definitely choose the economy with polar opposites when they're compared, okay? So there are some comparisons that I can make. So when you're trying to trade a pair that contains two mostly stable economies, so both countries aren't looking to do much, and they're not looking to raise rates, and the economic data seems to be quite in line, quite flat. Inflation is within the sweet spot. Well, then we could see the charts when you're looking at two currency pairs basically together, they'll start to consolidate. So price action will float around, it will become range bound as the general market's opinion and the overall economic data that's being released isn't surprising anybody. And until something changes, it's just going to remain in a range. So in this instance, you should not try and do any trend trading strategies, okay? Because you will get whipped out of your stop losses more times than not, and it will make a dramatic impact on your overall account. Okay, so I've put a tip down the bottom there. Triage your trades by prioritizing them after analyzing the economy. So just get some good understanding of just the basic fundamentals, and you can write it on a pad. And my first choice is always the polar opposites, because that's when the currencies are just going to move hard and fast. One economy is looking to raise rates and one's looking to cut. So I've got a little icon in there, and it says, it's got a picture of the euro, like with an arm wrestle with the dollar. And that's basically what's going on right now. It's the 3rd of April 2015 as I'm shooting this. And the euro is under a lot of pressure. They've just rolled out a massive quantitative easing program, and their economy is really in trouble. Greece is in a really bad way with debt. And then on the other hand, we've got the US economy, where unemployment is getting back down to record lows, and inflation is starting to show signs of picking up. And the government, the Fed, is looking to raise rates within the next couple of months. So their economy is expanding, and they're looking to raise rates to try and prevent the expansion happening too hard and fast. Where you've got the euro, they can't cut rates any lower, and they've resorted to a massive quantitative easing program. So they couldn't be two more polar opposite economies if they tried. Okay, so the point of this whole presentation is for me to try to emphasize to you that if you can use your technicals to time an entry and exit of a trade, but have the ability and have the skill set to learn the basic fundamentals so that you can review the currency pairs, and each week you know what currency pairs are strong, what currency pairs are weak. Are they looking to raise rates? Are they looking to cut rates? Right now, is inflation each single quarter getting higher and higher? So is their GDP growing? these are the aspects that you want to look at to determine what currency pairs you choose. And I hope that with this information, when you have a whole series of currency pairs, maybe the euro versus the US, the Great British Pound versus the US, and the Australian dollar versus the US, all alarm bells go off on your screen because all of your signals have aligned up at once. And you don't want to place 5 trades or 3 trades, or in this case it would be 3 trades, 1 on each currency pair, but you would rather manage just 1 order. Then you need to choose which one that you want to trade. And as it stands today on the 3rd of April 2015, I would always be choosing the euro versus the US because the economy of the euro is really weak compared to the US. Second choice would be the Australian versus the US because we do have an interest rate announcement coming up on Tuesday, and there is a opportunity for the RBA and a possibility that they will cut interest rates. So that means that if they're looking to cut interest rates and the US dollar is looking to raise rates, there's a massive polar opposite there as well. So they would both be my choice. Now, the UK economy is going quite well, and there's actually a very high chance that they would be the second developed economy after the US to start raising rates. So the moves in the Great British Pound should be a little bit less in terms of price action and volatility compared to the other 2 pairs. Okay, so hopefully that gives you some understanding of how I process and triage my trades, how I pick which trades I'm going to take. Of course, for myself personally, once I've got past that, I will be concentrating on the strong and the weak, and sometimes I'll even look at exotics. So if oil is rallying and the Canadian dollar is strengthening on the back of oil rallying, yet we have the euro looking to do this quantitative easing program, maybe I will match the euro and the CAD and the Canadian dollar, and I'll look at that particular cross currency pair, and there might be some great trading opportunities on that instead of sticking to the majors. And then I might be able to swing trade a long-term trend on the back of Europe still struggling and oil bouncing off the dramatic lows that we're seeing currently. Maybe there's something with gold. So that's how I process it. And hopefully this information will improve your trading. It definitely improved mine over the years, and that's why I'm bringing this presentation to you, because it's little things like this that improve your trading. It's not an additional indicator or anything like that. It's having knowledge of the market and putting some systems or some methods in place like this to improve your trading. Okay, so here on this slide, you can see the actual euro versus the US between May 2014 and March 2015. It's the worst quarter ever by the euro and the US, and that's due to the polar opposites. And this could continue to fall because Europe right now haven't seen the end of their easing. They're still rolling out quantitative easing program. They're buying $60 billion a month of bonds, and the US are getting closer and closer to raising rates. So if Europe doesn't look to stabilize their economy and the US look to raise rates sometime in the next 3 months, which it looks like it's on the cards, well then this euro is only going to continue to fall. And then we'll have the worst ever 6 months or 2 quarters in the euro. And we could be hundreds of pips lower. So understanding the basics of fundamentals for an economy can assist you in understanding the direction of the currency. Over the long term, this is just a 1 hourly chart. Sorry, that's a daily chart I've got put up there. So then you could break it down to say an hourly chart, and you could be swing trading each of these little market rhythms and moves and continuing to compound and make returns on that, knowing that the fundamentals are still pointing to the downside. So I hope that this is going to get you a little bit more enthusiastic about focusing your time on understanding the fundamentals and which currency pairs to choose and how to work out which ones are polar opposites. The fundamentals will actually make a great significant difference to your trading, more so than adding an additional indicator. Like if you've got an RSI on there and maybe you add an additional MACD, I don't believe that that's going to improve your trading. I know it doesn't with mine, and I've been trading the market for well over 10 years professionally. And the more indicators I add, the less consistent I am, because there's so many more things for me to look at and think about, that my strategy becomes so complex that I'm less likely to follow my own rules and follow all my signals. And then there's a lot of subjectiveness that comes with that. So understand the fundamentals, because the fundamentals is what's moving the market. So the fact that there is a massive quantitative easing program in Europe and the US are looking to raise rates, that is the real reason why the euro versus the US is falling. Not because two moving averages crossed on a daily chart or an hourly chart or a 4-hour chart. Not because the RSI is in bearish territory. Not because the MACD is trading below zero. So hopefully you get my point, and hopefully you will look to further your education in the fundamentals. You don't need to be an economist, and trading a currency pair with diverging economies can lead to larger price actions. It can lead to further market moves, potentially more pips, and most of all, you want more reliable market moves due to the stronger momentum. The reliability of the market moves is going to determine whether the stop loss gets hit and then all of a sudden the market ends up moving in the direction that you thought, because it was floating around and there was not much momentum at the time of you placing the trade, and it just drifted into your stop loss. So it is important, and it will improve your trading. All right, well, that's the presentation pretty much, and I hope that it will help. Please take it on board and provide any feedback on this. If it has helped your trading, let me know. And if there are other things that you're struggling with, maybe I can help with other tips like this.